All right, folks. So I'm going to go over the things I left out of the YouTube video and teach you a little bit more about institutional market structure. There's the euro dollar daily chart. And we've been mentioning this in recent commentaries and how that would be a bullish order block and price may react there, and it did. Traded there, rallied up, and right in here, okay, right in here we have one single pass where it creates a fair value gap between this low and this high, and the same high here and this low. Now I'm not drawing a line from this and this. I'm just drawing the attention to both of these candles making a single pass through and another single pass through. It's not important for this candle to come back down and touch this same low. The idea is we're bullish. We have been bullish on euro. We've been bearish on dollar. We were looking for this fair value gap to fill in and also run the buy side liquidity that was resting above this short-term high. When the market starts trading like this, the very next day, as the market drops down, that gives us an opportunity to be a buyer below the opening price. Okay, below this opening price is ideal, or at or very close to it. So when you see this entry arrow here and the exit arrow up here, you're going to see obviously me getting out before this fair value gap, because I don't want to teach the things I'm teaching in mentorship on YouTube. Okay, so given enough examples, there's a lot of smart people out there that would start drawing some parallels to things, and it's not my goal to give that stuff away there. But I'm going to teach the optimal trade entry in the YouTube version, but I'm going to throw in additional comments that is really just meant for you as a mentorship student. So the fact that we have a balanced price range in here is my trust, or the basis of my trust, I should say, that it will not go back down below that. So it allows me the opportunity and luxury of having a very small stop loss, as you'll see. So in here, we're expecting price to run above the short-term high for buy side liquidity, then back into the fair value gap as we have here. Okay, and a perfect delivery to that. In addition, I said that we would probably look for continuation here, and for Monday's trading, we can see that the market did in fact make an attempt to try to go higher. We're going to watch and see if we get above this consolidation and lower prices on dollar and higher prices on euro. But just keep this in mind here. This dark red line, that's the daily bullish order block. And these two red lines here, you'll see them later on, a couple slides later from now. And I'll show you this as the balanced price range. Okay. All right, so here is the hourly chart on the euro dollar. And before I get into this, just note that I did record a execution, and the link to that video on the execution and management where it hits the target, as you can see here, the entry and exit arrow, all of this has been recorded, so you can see there was an actual example. I'm not talking from pure hindsight. I'm using the actual things that I used in the trade example, and I'm going to teach you more depth behind it. And this is exactly how I would go into if I was starting all over again as a 20-year-old using just the information on this YouTube channel, just my ICT concepts. Everything as Inner Circle Trader, me, Michael. The things I would focus on primarily in the beginning is exactly what I'm showing you in this video here. Now the framework, obviously, if you go through all of the videos on the Inner Circle Trader YouTube channel, I teach this idea here, okay? And it's relative equal highs. And retail sees that as a very strong resistance level. Wyckoff does not talk anything about that specific area in price action, doesn't talk about it, doesn't mention it. And I draw strong conclusions that most retail traders think with this logic. And I adopted that mindset initially as a trader by reading John Murphy's book, Technical Analysis in the Financial Markets, which is the retail trader's Bible. If you learn everything in that book and turn it upside down, you can be profitable. Okay, because that's essentially what I did. So if I look at this relative equal high, and we're looking at an hourly chart here on euro, the idea is during the 17th of May 2021, this pattern right here, this rally up that clears a short-term high and trades right back down into this initial low, trades back down in as an optimal trade entry. I like this pattern. This is actually one of my favorite patterns to trade if I'm only going to elect to use the optimal trade entry. Now, obviously, I'm much more versed than just OTE patterns, but for this YouTube channel, I teach that as the flagship pattern. I am absolutely convinced, 100% sold on the idea that anybody that learns this pattern can find consistency, can find profitability, can quit their job, can grow wealth. All you need is this one pattern. The problem is you want it to form every 10 minutes, and it's not likely to satisfy that itch. So what I want you to notice is the underlying framework is we're in a bullish market, and we have these untapped relative equal highs. Okay, so there's a lot of buy stops resting above that because traders that have rode this down are going to have a buy stop resting up there to protect their short position. And or anyone that's bullish will have a buy stop above that, and it also builds more liquidity for buying. Now, why is that interesting to me if we're trading down here? Because I see a rally from here up and then back down in that did not take this run above these highs. So in my mind, I see this as a bullish optimal trade entry because we have had a shift in market structure above this short-term high. So now momentum's in force on the upside. The retracement back down in 79%, 62% in that area, that's optimal trade entry. Now, it's not just simply the fib level that makes it optimal. It is the fact that we have this underlying framework where we rallied higher, broke a high. We have unfinished business up here, okay? That's buy side liquidity, that's buy stops that have not been adequately traded into. So this retracement back down in, I view that as optimal trade entry. Now, again, I'm showing you an example that I recorded through TradingView. I'm not using the bullish position where it just shows you rectangles and shaded areas. That's hypothetical. That's not an execution. That's not an entry. That's not a management of any position whatsoever. Yes, everything I'm showing you in this recording and also pointing to for the actual recording on May 17, 2021 was a paper trade. For compliance reasons and legal reasons, I'm not licensed to give you trade advice or financial advice. This is just my opinion, and it's meant for you to be stimulated by the idea and go into it and study it on your own, and you draw your own conclusions. If you make money, wonderful, you did it on your own accord. If you lose money, you own that too. Neither of those things, whether it be good or bad, are my responsibility. I'm here talking because I like to talk. If you don't want to listen, fine. If you listen and you do something with it and you hurt you, that's your responsibility to own up to that. If you do something and you make money, take all the credit for it because you took the initial risk. Hopefully we've made ourselves very clear here. But paper trading proves theory. It proves conceptual ideas are valid, and the rules that I teach in this channel are in this specific day and in this specific pattern. But the underlying framework is this hourly pullback right here. Now, in this little short-term turn here, this is also housing a short-term optimal trade entry, but that's on another time frame and another discussion for another day. But as we retraced back down in, the underlying market structure is still bullish. The trend is bullish. The momentum is bullish. Even though it's starting to retrace, a lot of traders would see this and say, okay, we ran above these relative equal highs, and now it's coming back down to go lower. No, the underlying narrative is this is what they're going to aim for. Who is they? The institutional traders, the smart money traders, the non-Wyckoff people. So above here, those buy stops, it's the draw on liquidity. When this retraces, that's your setup. That's the framework. It's bullish. Now, we want to see it trade above these relative equal highs. Now, initially, if I was 20 years old and starting all over again, I would want to take something ahead of these relative equal highs because I'm going to grow as a developing trader, and this is all pantomime and, hypothetically speaking. I'm obviously a developed trader and no longer an early developing student of the market. But I would go into it trying to take an exit just ahead of these highs being taken out. That's what I'm framing here, okay? Even though the arrow up here shows that it's on this candle, don't let that misinterpret where the exit was. The exit was actually below 2180, and it was just a simple 30 pip run. We'll talk about that when we drop down to the lower time frame. But for now, just know that if I was 20 and developing, I would trust getting out just ahead of these relative equal highs, because that would be the first stepping stone to learning how to do partials. Partials are taking partial profits and allowing a portion out before these highs are taken out, and then holding for something that may or may not happen, but it does obviously here in hindsight, you can see it. But I like to teach conceptually and with examples, with logic that is understandable, even though it may be long-winded at times. But if you want to learn something, don't you really want to know all the intricate components and the subtle nuances that make you excellent at doing it? Not just, here, I'm going to show you a magic trick, and you watch it one time, you think you know how to do it, and you go over and try to show your friends, and it blows up and you get embarrassed. Okay, you don't know how to do what you think you thought you could do. Trading is just like that. And you don't want to just look at something and think, oh, this is easy, let me go ahead and just do the same thing I just saw this guy doing a video. You need to put work behind it. And gradually working towards understanding taking partials is, again, a graduated process. You don't simply know where you're going to take a partial. So you want to start initially, and this is how I would do it all over again, is I would train myself to take something ahead of where my actual target was. Now, some of you would say, well, that doesn't make any sense, because why have a target and not hold for it? Because you don't know, and as a developing student, you sure as hell won't know if these highs are going to be taken at any time during your trade. It might come back and hit your stop if you don't know how to do trade management and stop placement. So all these things have to be balanced. And that's why I talk a lot in the videos, because I'm not trying to waste my time. I want you as my students here, and those that want to incline their ear to my teachings, I want you to learn. I want you to learn it properly. I don't want you to learn from somebody else that thinks they know what I do because they know some of my lingo, my language, my vernacular. That doesn't equate to understanding how to do it actually. And that's really what I'm trying to press upon you in these videos. Not just this one, but all of them. Now, here is, again, a snapshot of May 17th, 2021. And I have not taken any trades since that day. All of this was pre-designed. I wanted to do this trade. I was using it for this teaching series. I have not blown the account. I've not added more wins. I have not taken any losses. I'm just showing you that this is the actual in and out, the orders, what time they filled, what time they executed, everything. Okay. So there was a stop placed. When the stop was canceled, it's not because I closed the stop or got rid of the order. It's because the sell limit order triggered. When that triggers, that cancels your stop. So I didn't cancel the stop ahead of the trade. I didn't trade without a stop. Watch the video that's going to be linked in the description below this video on YouTube, and you'll actually see a stop there. It's managed and using the rule-based ideas I teach in part 2 of this series. So with that, let's continue. All right, so we were back to this chart here, and I want you again focus on this area right in here, and you'll see that that price swing from this low to this high down to that low, that is the framework for optimal trade entry. It's optimal because it's within a larger area of potential running of buy side liquidity. So this high did not break that. This retracement only sets up an opportunity to get long and ride that to a run above these relative equal highs. You do not need it to run above those relative equal highs to be profitable. That's the major point. As a developing student, if I was 20 years old and trying to teach myself patience, I get a lot of questions even from my mentorship students. How do I develop patience? Because I put a trade on and I just want to get out when it's having just a little bit of profitability, and I just want to get out because I don't like the pressure. Well, that's because you're trading with money that you should not be trading with, and you don't know what you're doing yet. You haven't conditioned yourself or desensitized yourself to doing the same things over and over and over again, and not being dependent on the result being positive every single time. That's the purpose of backtesting. Training your perception of what these patterns look like over a long period of time, not just one sample set of a week or a month. It's 6 months. And you'll see how many times it fails and how many times it works. And using a rule-based idea, you'll see that if you're looking for a framework of 3-to-1 or higher, but 3-to-1 minimum, even if you have losing trades, and I'll talk a little bit about that also in this video, they can be overcome and canceled out by a long series of more profitable trades than not profitable. All right, so we're going to zoom in a little bit here, and I'm going to draw your attention to this candle right there. Now notice this candle has another lower candle and another lower candle. So all of my bearish candles are always a black candle. In bullish candles, I represent that with a green candle. So whenever we have consecutive down close candles after a major run like this, that takes out a short-term high. Okay, if that happens, that makes this a high probability bullish order block. Now I'm going to repeat that again. We're in a bullish market structure. We have this level up here that it may reach for. We don't know for certain, but it's likely to occur. This level is that relative equal high on the hourly chart that was shown before I zoomed in. This high being taken out here on this candle, your eye should drop right back down to these 3 consecutive candles. It's high and it's open. Those 2 levels are important. Draw that out in time, and you can see the market does in fact trade back down into it. It overshoots it by a little bit, but that's okay, because if you look at a sample set of different brokers' price feeds, this candle is going to have a lower low or a higher low, and it's going to be slightly off. But it doesn't make a difference, because if you have the high and the open, that's your range you're working in. So how do you use that? You use the highest level and add a couple pips to it for your spread. And if it trades down into that, that would be a bullish opportunity for an entry. I don't require the best entry, because sometimes that doesn't offer you an entry on a limit basis. It might trade just to that level and your limit may not trigger because of your broker's spread. Or it may not go to it exactly and just miss the opportunity, again, your limit order not tripping you into the trade. So you want to use the highest, easiest entry and allow for trade management to work a stop that respects this level as well. So we have this optimal trade entry with a bullish order block, and we're looking for price to run higher. The optimal trade entry is shown from this high, this low, and here's your 62% retracement level and a 79% retracement level. This is just to highlight a oversold condition relative to this range low and this range high. The Fibonacci is not the answer. Okay, it's not the magic, it's not the silver bullet. It's just a graphic visual representation of a short-term oversold condition relative to a specific dealing range. What is the dealing range? The dealing range is this low and this high. It's retracing back down in. Our belief is that it's not going to go below here. Our confidence is that we've done 6 months of back testing. We've seen this pattern over and over again. And with this logic, with momentum bullish, an underlying buy side liquidity pool that's most likely going to be drawn to, price is probably going to reach up there. Any retracement lower with this structure, and if it's occurring at a time of day between 8:30 and 11 o'clock in the morning, New York time, this is optimal trade entry. Now, that is my pattern. That's my optimal trade entry. That's OTE. Okay, ICT's optimal trade entry has all of those signatures, not just find a low, find a high, and then whatever their 62 or 79% retracement level, if it goes there, it's a buy. That's what trolls and neophytes think. They think that I'm trying to say I invented the 3/4 pullback, okay, or that I invented this. No, I didn't. I never claimed that. Okay, the structure of how I use it and all these things that come together, where it runs for liquidity, all of that together is mine. You don't find that in print. It's not in anything else. No one's talked about it until I mentioned it. And that gets under a lot of people's skin, but I don't care. I repeat it because there's too many new people coming into this business falling as a sucker to all these 20-year-olds that pretend that they learned this from Wyckoff or they invented it themselves. They didn't. So let's take a closer look inside of all this. So now, as a mentorship student, with that structure in place here, we have the backdrop of this balanced price range. So I'm confident this optimal trade entry is not going to fail and run out this low because we have this behind us. Remember that balanced price range on the daily chart? That's these two levels here. And this is that daily bullish order block. So we have an order block here. It trades down into that. Then it rallies. So what is it showing? Institutional order flow is bullish. We have a shift in market structure that's showing that, yes, we have momentum breaking here. And this retracement back down in is just simply an opportunity to be buying at a discount. So everything here is a go for a buy. Cut through these candles, folks. What do you see right there? That's a fair value gap. Take that range, project it forward, and this high here, project it forward. It refills this area. We had an imbalance. It trades through it and then comes back down in. That is now completely balanced over here. This is the initial rebalance where it just offers downside and then offers upside. But now it acts as what? It's a real support level now. The imbalance here becomes a support level. So that also is what's going on behind the scenes, and I'm not mentioning in the YouTube video. All right, so we're zoomed in here on a 15-minute time frame, and the Fibonacci is laid across this low to this high, and the 62% retracement level and the 79% retracement level is shown here respectively. And then we have that optimal trend entry with the order block. So there's a lot of converging things here that line up for something that would be otherwise viewed as bullish. If we look at how price shows this optimal trend entry and then using the level here, and I've shown this in my optimal trade entry pattern recognition series. So if you want to see the levels I have for my fib, you can find it there, and you can also find another alternative way of setting up your fib with the OTE primer. I'll leave it up to you which one you like, but the one that I actually use predominantly, if I'm being honest, is the one I show in my optimal trade entry pattern recognition series. Okay, so that's where you're going to find these levels. We have the short-term high here. When the market trades down in on this candle, I'm entering along. I'm entering on it because we've already seen willingness to want to rally here, and it's trading back down into this down closed candle, which is a bullish order block. So I have a lot of things lining up that post the likelihood of a run above this short-term high and maybe that relative equal high on the hourly chart, which is up here. So there's two pools of liquidity, buy side liquidity here and buy side liquidity here. As a developing student, you are not going to always have the confidence to get out here. That has to be a graduated, learned skill set. But we have a short-term buy side liquidity pool here that if we can run above that and get me 3-to-1 odds, if it pays out 3-to-1, that's good. And then I'll watch and study, does it give me that opportunity to see it runs above this buy side liquidity pool here. This is the relative equal high. This is just the short-term high. I don't need it to go above here to be profitable 3-to-1. My entry's here on this candle, and my exit's here, 3-to-1. I'm risking 10 to get 30. I'm risking 1 to get 3. I'm risking 50 bucks to make 150 bucks. However way you want to slice it, that's what we're working with as a minimum criteria. So I can't take the optimal trade entry trade in New York unless it gives me the framework that if it runs about 3-to-1 and it fits logically in this context like this, if it goes above an old high if I'm bullish, or if it goes below an old low if I'm bearish, and it offers 3-to-1, that's the trade I'm going to take. If it can't offer me that, and say the optimal trade entry forms a little bit higher up and it doesn't really offer me 3-to-1, I have to let it pass. It doesn't mean I won't paper trade it, or on paper I'd say I could take this trade and see how it would pan out, but I wouldn't have that much conviction behind the results and attribute that much to it, because it would be a trade that I would never really take or enter. So there's a measure of differentiation between looking at movements in price where you would engage and actually try to enter, which is 3-to-1 or higher, and those that don't quite fit that criteria, but you want to still study and observe it because it further solidifies the need for rule-based ideas, and it will teach you how using 3-to-1 as a minimum criteria, that is ideal because over time, your losses will be overcome by the wins. Okay, we're zoomed down into a 5-minute chart. And this is the time frame I used in the recording on May 17, 2021. And this is the actual candle right there. So as it was trading back down in and touching this down close candle. So now see all the layering? There's a bullish order block. There's another lower time frame bullish order block. And then there's a lower time frame bullish order block. And now we're doing it again here. So that is the fractal nature of using order blocks. It isn't just pick one time frame that the order block only works in. It's understanding the logic. This low here already shown a willingness to send price higher. We retraced. So when we have price running back down into the previous down close candle there, as it was going lower, I'm buying. I'm going long as the candle's going down. As a developing student, that doesn't feel natural. It feels a little uncomfortable. And you have to overcome that by going through copious examples of looking at back-tested data, looking at hindsight moves, and seeing how many times it forms. And seeing it so many times that you burn it into your subconscious. Then practicing going forward after 6 months. This is the stage I'm in, hypothetically, and I'm pantomiming with you here in this video. For part 3, I'm pretending to be a 6-month versed, back-tested student. And I'm now starting to practice doing entries. That's the timeline. That's the ideal ICT approach to learning from this YouTube channel. If you try to do it faster, you will not get the results you want. You will rush. You will try to put money into an account because you're going to hear other people say, you got to put a little bit of skin in the race. No, because if you don't know what you're doing, you're just fortifying bad habits, toxic thinking, and you're only guaranteeing you're going to be fearful or greedy. And either one of those two demons will overtake you, and you'll never be where you want to be at because you won't have the experience to say, I'm going to stay with it even though I'm not doing well, because you have lost money. It's one thing for you to have your pride and ego hurt because you're learning how to do it and you didn't lose any money. But when you add money to it, all that does is add a very clear punctuation at the end that not only is this painful, but it's costly. And do I really want to spend more time doing this stuff if it's taking money out of my pocket? It adds to the hurdle that you got to leap over. It increases the height of the mountain that you think it is to climb over to get to successful, consistent trading. So you have to strip it down to that elementary stage of it's just writing alphabets over and over and over again. It's a small little simple task. It doesn't take anything from you, but over time, it builds in a perception of character recognition, which is pattern recognition in trading. We have a time window here, 8:30 in the morning to 11 o'clock in the morning, New York time. It's always New York local time. The first run into that order block, the opening price on the hourly chart, it bounces off that. Then we have a down close candle here. We ran above it, and then the next candle we trade down into it right there. I'm going long there. I don't need this entry, and I don't need this entry because the overall context is I still have enough entering here that if it runs above this level and gives me an exit here, that's 30 pips. That's 3-to-1. And I don't need this level to be traded through. But I'm going to watch and observe it and train myself by experience to see this occur. And then by conditioning myself with real examples, walking forward in a paper trading account, not live funds. Live funds comes another 6 months later. Okay. Now, let me slow you down again because you're all thinking, all I got to do is do 6 months. I can do that now. No, you're going to study back-tested data for 6 months. Then you're going to walk forward in paper trading or demo trading for 6 more months. That means that you can't touch a live account for a full year. Some of you are wanting to turn the video off and go to the next mentor. Do it, because I promise you, you will be back here. You will be back here when you taste all the other garbage that everybody else is trying to sell you. The Instagram stuff, all that stuff, forget about all that stuff. Because that's not going to get you where you want to be at. Right here is home. You don't have to believe me now. Go out there and taste the slop that everybody else is giving you. Watching when that fails. Watch when you fall victim to all that glitz and image and materialism. And I have all that stuff, but you never see it. I have the wizardry here in the charts. And this is how you get it. You learn it this way. You don't learn it by looking at rented cars. Period. 3 to 1, entering inside of a specific time window of the day. How incredibly convenient. Now you can structure a business model around time of day. When are you looking to do a trade? If you're new, you have no idea. You're looking at all these candles like, how do I know when to do anything? You have a window of 3.5 hours, Monday through Friday. What are you going to do? You going to try to trade at 12:30 in the afternoon New York time? No. You're going to get up early and trade London? No, you don't have to. But there's some good moves in London. So what? There's good moves on Sunday sometimes too. I'm not worried about that. It's narrowing your focus to the best of the best of the best. That's what this process will do for you. But if you don't believe me, then you're never going to do it and you're never going to see it for yourself. But once you submit to this process, you'll see it. And then you'll regret never having done it sooner. Or listening to everybody else's excuse why my stuff's overcomplicated. Because none of this stuff is complicated. I'm stripping this down to a way where you all have no excuse that you all can quit your job in 36 months. 3 years. If you know how to do this and you have 2 years behind you and you invest a respectable amount of money and consistently do it and you have a real nice return every single month, yes, you'll have losing trades. You can still carve out a career. Now, will you be making $200,000 a year? I can't promise that. I can't promise any amount. But can you do it 36 months from the beginning stages of you submitting to this process and not requiring to live on a paycheck that's given to you by someone that tells you when you're no longer needed? You don't want an employer. You don't want a job and you don't want a paycheck. You want your own way, your own path. And that's all I'm offering. If you just listen to me, this is exactly how I would do it all over again. And in 36 months, I would be retired again. Nobody else is teaching like this because nobody else is rich. Nobody else has made millions. Nobody else knows how to do it. Nobody else does executions. Nobody else proves this theory before it happens and outlines it like I do. So you're welcome to disagree with what I'm saying. You're welcome to have the opinion I talk too much. You're welcome to have all of these conjectures about why does he not do it with a live account? Why doesn't he do this? And why doesn't he show his cars? And why doesn't he do this and that? Focus on the things I'm teaching you because these are the only things that matter. What I drive and where I sleep has no bearing on how much you're going to make or how fast you leave your job. This process works. And this is exactly what I would do if I had to start all over again at 20 as a neophyte and given this the information that this YouTube channel has. This is exactly what I would be doing. Focusing on this tiny little window of opportunity, specifically on Monday, Tuesdays, and Wednesdays. I wouldn't touch a Thursday. I wouldn't touch a Friday. What am I talking about? The weekly range bias that I teach on this YouTube channel. So if I'm bullish, I'm looking for a Monday, Tuesday, or Wednesday trade between 8:30 and 11 o'clock in the morning, New York time. If I don't get it, I don't trade. If I miss the entry, then I wait. If it doesn't give it to me on Tuesday, then I try one more time on Wednesday. And if I don't get it Wednesday, I don't take any trades that week. I lost nothing. I invested some time observing and watching. But that's experience now I have. If I'm bearish, I'm looking for shorts. Just everything that's shown here, it would be reversed. On Monday, I'd look for a short between 8:30 and 11. Or Tuesday, I'd look for a short between 8:30 and 11. Or Wednesday, I'd look for a short between 8:30 and 11. Thursday and Friday, Saturday and Sunday, they're off days. Now think about that. Think about it. That's 3.5 hours a day. But if you get your one weekly setup, that gives you your weekly payout of 3 to 1 or more. Again, it's just the minimum criteria, 3 to 1. You're going to see that there's opportunities that offer more than 3 to 1. It could be 5 to 1, 6 to 1, 8 to 1 in the same day. But you won't observe them until you get used to seeing what they look like. And you find that by looking at it for 6 months in hindsight. And you study that. And once you get a feel for what it looks like in hindsight, then you start testing it and walking forward with it. And you grow in your understanding and your patience. And then over time, you're going to learn that you're going to take something off ahead of this, just above this high, and then leave a portion. Once it runs above that, then you close the trade. That's double tap. Take something off, hold for a higher position, exit if you're bullish, or hold for a lower position, exit if you're bearish. 2, take profits. One's a partial, the other one is your final close. You grow into that next level of understanding for targeting. So I've already covered how I would filter out my trades. I've already covered what time of day and what days I would trade. We're only looking at euro dollar. I'm not complicating it by adding different pairs. I'm not even talking about cable. British pound hasn't even entered the conversation or chat. I haven't even talked about dollar index. How easy is this? It's extremely easy. In that little area right there, that's my entry. In my mind, I'm submitting to, I don't care how long it goes sideways, I'm holding for here, and it might go up here, but I don't need it to because 30 pips is just below it. And that's 3 to 1. That gets me out. I'm training myself to be content with profits, not being right. Right is going above this level here. Notice that? The idea was initial draw was on that relative equal high on the hourly chart. That is the right. I don't need right to be profitable. I need to be profitable. Profitable is it's moving in my favor. It's offering me 3 to 1. I don't know at that time. I don't know if it's going to trade above there. It could go right to that level and come back down and clean this out and scare me out of the trade. Remember, I'm a developing student. You have to be realistic. I'm trying to make this as realistic as I possibly can. I'm giving you all the possible curveballs that could happen. And you have to know these things. These are pitfalls when you're developing. If you don't have a mentor that's gone through it themselves and found consistency, you're never going to learn how to do this yourself. It's too easy to paint this to, it's so easy, anybody can do it. It's so easy. Forex is so easy. And they never execute a trade. You never see them managing anything. All I'm trying to do is show in strong contrast what it's like when you know what you're doing versus what everybody else does here on YouTube and Instagram and Discord and Telegram. And that's why I'm not liked. That's why I'm trolled. You keep the focus on your development. You keep the focus on the things I'm teaching you to do, because you'll find out really quick if what I'm teaching is real or if it's fluff. This right here is one optimal trade entry. If you're looking at optimal trade entry alone, this would have been an entry there. I missed this by timing, putting the chart on. I didn't see it as it formed. So when it traded back down in, this order block with this underlying framework here, that's what I was basing it on. Remember, this whole run up here was an hourly optimal trade entry. Then you have a smaller one here. So this is a fractal of what I showed you on the hourly chart. Remember, this is 5 minute now. So this initial run up and then down, that's the optimal trade entry on the hourly. Then we have this small little run here. That's an optimal trade entry as well within a larger one. That's really bullish. But I missed it there. I didn't have the chart open at the time. So when it traded back down in, I'm using this order block because I want to be positioned on the logic that's used from this low to this high to that low. I'm trusting that. Why? Because it's occurring inside of that window of New York session, 8:30 to 11 o'clock in the morning. So this run here, this is the ideal entry, yes, for OTE purposes during New York, because this is ahead of New York. 8:30 starts here, so it's a little ahead of it. So this is the first opportunity to go OTE, bullish, high odds in your favor. And I used the context of the bullish order block there. In the recording on May 17, 2021, you watch me do this one here, and I say this is a live call. That's a buy. As it's trading right down in there, I label it using TradingView. I type it out. That's a buy. That's the New York session buy. It's from this low to this high down in. But before that one occurs, you have this one as well. You have this low to this high down in. That could be a buy too. There's nothing wrong with that. And then you have this one as well. Here to here, and it would be in this entry. But now when you have this, you have to use this low in the context for your stop. So it doesn't need to go completely below that low. You can go just below these bodies of these candles here and put your stop right in there. My stop initially was 121.35 and 3 pipettes. You see it in the trade. From entry through the whole process, it's being managed with the rules that I gave you in part 2 of this series. That's how I use that stop. It teaches you proper trade management and stop management. Nobody has a real clear idea on how to manage a stop. That's why everybody that's learning from everyone else is either getting stopped out, even if their trades are, well, let's not call it profitable. Let's say their trades are right in a direction, and say they had a pretty good entry point. They don't know where to put their stop loss, and they put it up there too close to their open profit or where the market's trading now because they don't want to have a losing trade. And that's what you have to overcome. And the only way you overcome that is seeing how the back tested data shows that this logic is strong. This kung fu that I'm showing you is strong. This is all algorithmic. These things repeat every single day. Not every single day do you get 3 to 1, 8 to 1, 10 to 1, 12 to 1. But the ones that do offer 3 to 1, that's what you look for. That's what you focus on. All right, folks. This is the 50-minute time frame for the dollar index. And you can see we did trade off that optimal trade entry. I said we would probably work lower. We had a nice little Judas swing here. Ran up buy side liquidity here. Small little fair value gap. Extended out in time. Went a little bit above it. That's fine. That's what it's reaching for. Creates the high of the day. Sells off. Mean threshold of the body. Aim for that. Optimal trade entry here, New York. Sells off. Trades back down into the opening that's left right here when that small little imbalance between this low and this high. Fills that in and then consolidates. Goes still softer on the close, but overall we had a nice respect of delivery on the downside. Euro dollar 15-minute time frame. Nice little wicked Judas swing on the downside. London session. Rallies back up. This area right in here. Trades up into that and then completely returns back to the fair value gap on the hourly and daily chart. That's the discount low of that. We trade off of that and consolidate into the close. We're going to see if it wants to trade higher. We're basically working with a market maker buy model here. And buy side liquidity resting above here is what's likely to be targeted next. And cable, this one's kind of ugly. We have the breaker here, trades up into that, and it's essentially the consequent encroachment of this tail on the down close candle. Midpoint of that, draw that out in time. Bang, hits it there in London, creates the high of the day, breaks down, and has a nice sweep on the sell side liquidity here to the tune of about, 20 pips or so. We'll call it 41.35. We'll round it to that. 41.35, so that's 10 and 20 pips, and it goes a little bit above that, or below that rather. So about 20, 25 pips. Basically what I teach you here. And once it did that, we rallied back up, and now we're just consolidating. Cable, again, it's been really difficult to get a good read on this one. So the better trading is obviously in euro dollar. So hopefully you found this insightful. Until I talk to you in midweek review, enjoy the rest of your week, and tomorrow will just simply be the PDF daily log entry.